Enron, the biggest financial fraud. The Enron scandal, often described as the biggest financial fraud in history, remains a striking testament to the depths of corporate deceit, greed, and regulatory shortcomings. It is a story of how a once promising energy company, Enron Corporation, transformed into a symbol of unscrupulous practices, massive financial deception, and an epic corporate downfall. The birth of Enron. The Enron scandal is an intricate tale that warrants a meticulous examination from its very inception. Enron, a name that would eventually become synonymous with corporate fraud, had its humble beginnings in 1985. It emerged as a result of the merger between Houston Natural Gas and InterNorth, two companies engaged in the energy sector. This amalgamation marked the genesis of a corporate entity that would eventually make a profound impact on the financial world. The rise of Enron. Enron's ascent from its modest beginnings was nothing short of meteoric. In a relatively short span of time, it had transformed itself into a financial powerhouse, a behemoth in the energy sector, and a symbol of American corporate success. Its rapid rise was driven by a combination of factors, but two key elements stood out: financial innovation and aggressive expansion. Financial innovation. One of the cornerstones of Enron's success was its pioneering approach to financial innovation. The company's executives, notably Jeffrey Skilling, introduced a concept known as mark-to-market accounting. This accounting method allowed Enron to record the anticipated future profits of its projects immediately, rather than over the long term. This had the effect of inflating Enron's reported earnings, which in turn made the company more attractive to investors and lenders. In essence, it allowed Enron to present a rosier financial picture than its actual performance justified. Aggressive expansion. Enron's growth was not solely limited to its core business of energy trading. The company aggressively expanded into a variety of new markets and industries, from broadband services to water and sewage treatment. This diversification was part of Enron's strategy to position itself as a new economy company and to capitalize on the dot-com boom. By doing so, Enron aimed to maintain its image as a forward-thinking and dynamic corporation, further boosting its stock price and attracting more investors. The unraveling begins. Enron's meteoric rise was, in many ways, built on shaky foundations. The financial innovations that had made it appear so profitable were increasingly being questioned. While Enron's financial statements and reported earnings seemed to suggest a company in robust health, there were growing concerns among some financial experts and analysts. The complexity of Enron's financial transactions and the opacity surrounding its accounting practices raised red flags. A key factor that would ultimately contribute to Enron's unraveling was the company's use of special-purpose entities, SPEs. The House of Cards collapses. The unraveling of Enron's financial deception and the subsequent collapse of the company was a series of events that would reverberate through the financial world and leave an indelible mark on corporate governance and regulation. The discovery of financial irregularities. The beginning of the end for Enron can be traced back to a series of revelations and discoveries. In August 2001, Sharon Watkins, an Enron vice president, sent an anonymous letter to Kenneth Lay, then Enron CEO, expressing concerns about the company's accounting practices and the extensive use of special-purpose entities to manipulate its financial statements. Watkins was one of the whistleblowers who would play a pivotal role in exposing Enron's fraud. The letter itself was a harbinger of the turmoil that lay ahead. It pointed to questionable practices, conflicts of interest, and potential legal violations within the company. Stock price plunge and credit downgrades. The financial community's growing skepticism had a significant impact on Enron's stock price. In August 2001, the company's shares began a precipitous decline, erasing billions of dollars in market value. Investors, who had once been enamored with Enron, started to lose confidence in the company. As the stock price fell, it triggered a series of events that only deepened Enron's problems. One of the most significant consequences of the falling stock price was the triggering of clauses in Enron's financial contracts that required the company to post additional collateral. Enron was heavily reliant on maintaining a strong credit rating to secure favorable terms for its complex financial transactions. Enron's desperate measures. As Enron faced mounting financial pressure, the company's leadership embarked on a series of desperate measures to shore up its finances and prevent further damage. This included the sale of non-core assets, such as power plants and pipelines, in an attempt to generate much-needed cash. Enron also engaged in a complex series of transactions to shift its debt to off-balance sheet entities. One of the most notorious actions taken by Enron was the creation of a special-purpose entity called Chuco, which was used to keep hundreds of millions of dollars in debt off Enron's balance sheet. The collapse and bankruptcy. Despite these frantic efforts to stave off disaster, the inevitable eventually occurred. By late 2001, Enron's financial situation had become untenable. It was unable to secure additional financing, its credit ratings were in freefall, and the company's stock price had plunged to near worthlessness. On December 2, 2001, Enron filed for Chapter 11 bankruptcy protection, marking the largest bankruptcy in U.S. history at the time. The company listed over $63 billion in assets and more than $38 billion in debt. Enron's rapid and catastrophic fall from grace sent shockwaves through the financial world. It wasn't just a financial crisis, it was a corporate implosion of epic proportions. The aftermath of Enron's bankruptcy was devastating. The scandal's far-reaching consequences. The Enron scandal's impact was not limited to just the company and its immediate stakeholders. It had far-reaching consequences that reshaped the corporate landscape, influenced regulatory reform, and left a lasting legacy in the world of finance and corporate governance. Regulatory reforms. The Enron scandal exposed glaring weaknesses in the regulatory framework overseeing corporations. In response to the scandal, the U.S. government implemented significant changes to corporate governance and financial reporting. One of the most prominent of these reforms was the Sarbanes-Oxley Act of 2002. Sarbanes-Oxley, often referred to as SOX, imposed stringent regulations on corporate governance, internal controls, and financial disclosure. It required CEOs and CFOs to personally certify the accuracy of their company's financial statements, increase the independence of corporate boards, and establish the Public Company Accounting Oversight Board, PCAOB, to oversee accounting firms. Loss of trust in corporate leadership. The Enron scandal eroded trust in corporate leadership, not just within the energy industry, but across all sectors of the economy. Investors, employees, and the public had been led to believe in the company's success, only to witness its catastrophic collapse. This loss of trust had profound implications for how companies were perceived, and it heightened scrutiny of corporate practices and ethics. Impact on accounting and auditing practices. The role of auditors came under increased scrutiny in the wake of the Enron scandal. Arthur Andersen's involvement in the scandal, along with allegations of shredding documents and obstructing justice, led to a loss of confidence in the auditing industry. As a result, the auditing profession faced greater oversight and regulation. The Enron scandal is a powerful cautionary tale that continues to reverberate in the world of finance, business, and corporate governance. It serves as a stark reminder of the devastating consequences that can result from unethical behavior, a lack of transparency, and the manipulation of financial statements. The rise and fall of Enron, once an emblem of corporate success and innovation, ultimately exposed the dark underbelly of corporate greed and deception. So guys, let me know your thoughts in the comments section below. For more interesting content, give this video a thumbs up, and don't forget to subscribe to the channel for more awesome content. Have a nice day, and I will see you in the next video.